audit documentation. So, we've put this in a nutshell so far, just to say, just document anything and everything. But let's be a little more precise, I guess, on this. So our documentation as an auditor needs to be such that it supports our opinion, our auditor opinion. We need to kind of have a one-stop shop, the audit work papers, the audit file, with all our stuff documented enough to support the opinion that we gave on the financial statements. It needs to support our opinion. Eyes are dry tonight. It needs to show that our audit was conducted in accordance with GAS. It needs to be such that a peer reviewer should be able to look at our work papers. They should be able to duplicate our work if that was what they were going to do. They're not going to do that, but they should be able to duplicate our work. So I wouldn't have a statement in my audit documentation that says I sampled 50 and they were good, right? You would want to document a whole lot more precise than that, right? We want the specifics. Audit documentation is the auditor's property. Audit documentation, we'll typically call it work papers in real life, or that's what we always did anyway. So this is just a basic thing we need to know. We touched on this in like week 2 when we were talking about discreditable acts, I believe was the title of the little section there. We talked about things that the client's entitled to request entitled to if they request it, and things they're not entitled to. The working papers, these are things that were prepared by us solely for the purpose of the engagement, and they're our property, and the client's not entitled to it. They should not be provided to the client. They should not be provided to anybody, because we would break confidentiality rules by releasing those to someone, right? So the only reason we would give those to anyone is something anything that's confidential we can do with client permission or subpoena or to AICPA body, that kind of thing if they request it. So that all goes back to that confidentiality chapter we talked about early on. So audit documentation should permit an experienced auditor to understand all this stuff. There's that nature, timing, and extent thing. So they should understand what types of audit procedures were done, when they were done, and how much of it was done, and the results of those procedures and the conclusions reached, and whether accounting records agree with the financial statements. They should be able to essentially recreate the whole audit if they wanted to. And then the rest of this is just kind of how many days should they take to put the final file together. So the rule is we should complete assembling the final audit work paper file no later than 60 days after the report release date. That differs for a PCAOB audit. That is 45 days for them. We are not allowed to delete any audit documentation after the documentation completion date for obvious reasons. We can continue to add after that date, but if we do, we got to document what was added and why. So those are some rules. And we need to retain these audit documentation files for at least 5 years from the report release date. That would be 7 years for a PCAOB audit. These are just facts that you kind of have to tuck away. I'm not big on memorization type things, but that's just kind of what this is. We've said document everything. Here's 3 things that you are specifically required to document. They do make a point. This needs to be there. The misstatements, the analytical procedures, and any going concern issues. But really, anything needs to be documented, honestly. And then they define permanent file versus the current year files. Pretty obvious stuff. Permanent file is going to have ongoing significant things like legal documents, contracts, articles of incorporation, bylaws, debt agreements, long-term type of things. Understanding of internal control, historical financial stuff. Current year audit files would be things that relate to the current year, the audit plan, confirmations, management rep letter, engagement letter, consideration of fraud for the audit, assessment of internal control, all that stuff that applies to the current year audit. Pretty easy, obvious stuff. So PCAOB on audit documentation, I put some more notes there, but let me just kind of nutshell this. It's pretty much the same as the AICPA for our purposes anyway. The big differences are stuff I mentioned in this page up here. The big differences are retain the work papers for 7 years instead of 5, and complete the documentation within 45 days of the report release date instead of 60. So there's really not much use to look at this stuff. It's the good stuff's already in this part of the notes, but that's what I typed out as I was reading it. So I left it. I did have a few questions to look at here. Close this out so it'll be gone. Number 4. Okay. Which of the following statements ordinarily is correct concerning the content of audit documentation? A says, this is kind of another one of those where it's like, oh, I'm learning new information from this one. A says, whenever possible, the auditor's staff, not the entity's employees, should prepare schedules and analyses. I read that and I think, yeah, that's probably right, but it's not. So you kind of pick up some new information from this one. So they make the point with A that using the client staff whenever possible, that's what you should do, because they can prepare schedules and things like that that we can look at. Instead of getting our own audit staff to pull all this stuff together, let the client's staff do that. So they do make the point when it's possible that the client staff, not the auditor staff, should do this. So A was kind of tempting to answer, but it's not the right one. B says it's preferable to have negative, oh yeah, this was neat. It's preferable to have negative figures indicated in red instead of in parentheses to emphasize that amounts are being subtracted. So with B, they're making the point that you should not do this. You should not have negative figures in red, because if you photocopy that, you lose the red and then nothing makes sense anymore. So that's kind of why we use parentheses like that. Makes sense, right?
I never knew that until then.
There you go.
I wonder why everything is in parentheses.
Yeah, I guess, I mean, I kind of am guessing that's the history on that, because, yeah, negative signs don't jump out at you as much as parentheses either. But yeah, red just wouldn't work. And, now you can make color copies, but not everybody does that. She said, it is appropriate to use, this is kind of a outdated one a little bit, I think, but C says it's appropriate to use calculator tapes with names or explanations on the tapes rather than writing separate lists into the audit documentation. Now, this is the right answer. The point is we're trying to be efficient, right? So we can just slap that in there and make notes instead of copying a bunch of junk over again, right? Now, it's a bit of an outdated question, but the point is still there, right? It's more efficient. There's no need to suck up time unnecessarily by recreating something that's already there. So that's the point that's being made. D says the analysis of asset accounts and their related expense or income statement accounts should not appear on the same working paper. They should. Yeah, things that make sense and are related, it's more efficient to have them kind of right there in front of you instead of having to flip flop all over the place. So yeah, 4 is a little outdated, but it makes some really good points. You know, we want to be efficient, and we want it to be efficient for us to prepare, but we also want it to be efficient for someone to look at. And if it makes sense for the asset account to be on the same page as the related expense account, that's what you should do instead of sticking it somewhere else. Number 6. Which of the following is not required documentation for an audit in accordance with GAS? So here we are again. So we're looking for the thing you're just not even required to do in the first place. A says a flow chart or an internal control questionnaire that evaluates the effectiveness of the entity's internal control policies and procedures. A is not something we're required to do. So if we're not required to do it, it wouldn't be required documentation, right? Now, I'm not going to immediately answer A without looking at the others, but A is the answer. So the others are going to be things we have to do no matter what. We do have to have an engagement letter, right? We do have to indicate that the audit documentation, in the audit documentation, that the accounting records agree or reconcile with the financial statements. We mentioned that. D is something we're going to have to do. We're going to document the basis for our conclusions, blah, blah, blah. So A, it's not something we have to document because it's not something we have to do. 7 is kind of similar. Which of the following is required documentation in an audit? So now which of the following is required documentation? So we're kind of looking for the thing we are required to do in the first place, all right? So A says a flow chart or narrative of the accounting system. We're not required to do that. We're not forbidden from doing it, but we're not required to. But look at what B says. This is something we're definitely required to do. An audit program setting forth in detail the procedures necessary to accomplish the engagement's objectives. Of course, that's the whole thing, right? Of course, we have to document the audit program. C, we don't need a letter signed by the client acknowledging responsibility for preparing requested audit schedules by a specific date. It's not something we're due. And D, we don't have to have an internal control questionnaire. So there you go. So kind of get a feel for those types of questions. Well, number 10. Which of the following pairs of accounts would an auditor most likely analyze on the same audit documentation? So that kind of builds off of what we were saying up on number 4, you know, with the whole efficiency of putting things on the same page. So which of these would we most likely analyze on the same documentation? We're looking for things that are related. Those would be most efficiently put together on the same audit work page. Note receivable and interest income. That seems very related, right? Note receivable is an asset, and interest income results from that receivable. That would be a nice, neat work paper where you are able to test the receivable, test the income. There it is, right in front of you all together, right? That's it. That's the answer. These others, not as related, you know, accrued interest receivable and accrued interest payable. Those aren't related at all, right? There's no reason those would make sense and be efficient together on the same work page. Notes payable and notes receivable, those aren't related at all. Interest income and interest expense, those are not related, you know, but A is related, right? The receivable and what results from having the receivable. Makes sense, right? That's a pretty good one. The PCAOB questions are all very straightforward. So, you know, it's like how many years, right? So, no sense in going over that. All right. I like this week. It's straightforward, kind of easy to run through. Confirmations. These are easy. You know, this is something that is just kind of easy to think about and visualize and actually do in real life. So confirmation is an audit procedure. It's an inquiry of a third party. We're asking a third party about balances, things like that. You know, there might be bank confirmations that we send to the bank, so they'll confirm the balances of accounts. But banks can confirm a lot of things. They can also confirm any investments that the company might have with the bank, and they might also have outstanding loans that they would confirm. So you might have a lot of different things to confirm with a bank. Receivables confirmations you might send to customers about what the customers owe the company. So there's different types of confirmations. So you're just getting external third-party verification of balances that are on the balance sheet. So, oh, I should put the notes on the page. There we go. Sorry about that. I haven't talked about anything that's actually written on the page yet, so that's fine. So here we go. External confirmation. So audit evidence is obtained as and this is an important little thing to take note of and not let it slip by. It's a direct written response from a third party. That's what an external confirmation is. Not an oral response, not an indirect response. It is a direct and written response from a third party. There are two kind of main types here, and there's a stronger form of evidence versus a weaker form of evidence here. So there are positive confirmation requests. These are stronger evidence. So we want the person we're sending this confirmation to respond directly to us by writing in the requested information or agreeing with the amount that we put in there. So a positive confirmation is strong. Having them write it in there themselves would be the strongest. Having them agree with what we write in there is not quite as strong, for obvious reasons, right? You get one of those, you're busy. Yeah, it looks right, you know. But if they have to write it in, they have to actually go in there, look it up, and write it in there. So there you go. But yeah, either of those would be a positive confirmation request. Positive in that they have to reply one way or the other. They're going to say, here it is, or yes, I agree with this, as opposed to a negative confirmation request that we're about to talk about. So if they don't respond to this positive request, that is a loose end. We got to tie it down. So we'll send a second request, maybe a third request. If they still don't respond, we need to figure out some other way to get at this amount, some alternative procedure. So positive confirmation is stronger. We would obviously use this, you know, if there was a somewhat material account balance or something like that. Negative confirmation request is less strong. The kind of thing that would drive me crazy. I just don't trust them at all. Just my mind wouldn't like this. When I was doing auditing, I never did these because it just drive me crazy. So you request the confirmation party to respond only if they disagree. So it's like, here is what we have. If this is not true, let us know. Now, we know how people are. Right? Oh, I'll get to that eventually. Oh, I'll get to that eventually. Yeah, I still need to do that. And they never do. Right? To us, that would be evidence that it was fine. Right? A non-response means they agree. Now, obviously, there's a risk there. So that being the case, it's weaker evidence. Because it's weaker, we would probably want a much larger sample size than we would need with the positive confirmations. So this is good when there's a big, huge number of smaller items. You would want to get positive confirmations of all of those, right? You'd want a sample of some of them, and that would be fine. This would be good when the risk of material misstatement is low and if the controls are strong, right? Which goes back to our whole, you assess control risk to be low. That means you don't have to do as much and as strong of evidence gathering, right? So this would be a weaker evidence for that. So, with the positive confirmation we mentioned, loose end, if they don't respond, second request, third request, if they still don't respond, we need to figure out a different way to get at it. What might we do? If it's a receivable, see if the cash was received later on, right? That's a quick and easy way to do it. If there's been time for it to been done with, right? Payables, verify that what they're showing as payable was actually paid, right? If we're far enough into the next year, hopefully that's already been dealt with, and that can be our evidence that it was fine. A good point to tuck away is that the auditor needs to have control over the whole confirmation process. We don't want the client sending confirmation requests. We don't want the client receiving those back. We, the auditor, needs to prepare, send them out, and we, the auditor, needs to receive them. We need to have complete control over that process for obvious reasons. Standards require that we should do this for accounts receivable unless it's an immaterial, or if confirmations for whatever reason would not be an effective way to do it, or if the risk is low and there's other procedures that address it. Just a lot of unlesses there, but basically the standards require that we do this for accounts receivable. That's kind of the takeaway here. We can argue and reason away not having to do it if in real life, but for test taking purposes, our takeaway is confirmations are required for accounts receivable. And another good thing to tuck away is, what are we testing here? We are testing the existence or occurrence assertion, right? We are taking a financial statement number and seeing if it is something that really exists, right? Not testing completeness here, because we are using the financial statements as our source for mailing these confirmations out. That doesn't cover completeness, right? Because if it's not in the financial statement records, we're not sending a confirmation for it, and we're not going to know about it. We'll have to test completeness another way. Okay, so that's confirmations. A couple to look at. About number 5. Which of the following statements is correct concerning the use of negative confirmation requests? Which of the following is correct? Unreturned negative confirmation requests rarely provide significant explicit evidence. That's your answer, right? Unreturned negative confirmation requests could easily be misinterpreted. It could be, yeah, everything's cool, or it could mean, yeah, the person who got this request didn't do what they were supposed to. It could easily be either. So it's a weaker form of evidence. Would not be a good form of evidence to use if we were accepting a low detection risk, right? Which is what B says. B says negative confirmation requests are effective when detection risk is low. That is an incorrect statement. C says unreturned negative confirmation requests indicate that alternative procedures are necessary. Yeah, it does not, because unreturned negative confirmation requests means everything's cool, right? So it would not indicate we need to do alternative procedures. If it did, there would be no point in sending that type of confirmation at all, because you would necessarily be doing alternative procedures afterwards. D says negative confirmation requests are effective when understatements of account balances are suspected. No, because if it's understated, that means things are omitted, which means we don't have the right thing to send to the right people to be confirmed, right? So that was a pretty good one. 7, under which of the following circumstances would the use of the blank form of confirmation? So this would be a positive confirmation where they have to fill in the amount, as opposed to a positive confirmation where we fill it in and say, sign off if you agree and send it back, right? So a blank form, under which following circumstances would the blank form be most likely to be preferable? They say over negative confirmations. So anyway, A says the recipients are likely to sign the confirmations without devoting proper attention to them. Well, that would definitely be a scenario where the blank form would be preferable to any other form of confirmation. If we don't think they're going to devote proper attention to them, we want to make them actually fill it in so we can determine that they did actually give it proper attention, right? So A is it. So if we think that, we're going to make them do a little more work to complete it. Counting estimates. So we want evidence that accounting estimates are reasonable and disclosures are adequate. So what are estimates really? They're typically some approximation of an amount that we'll eventually know once the actual once we actually know what the outcome is. So, we estimate things like warranty expense, for example, uncollectible accounts receivable, pension expense, litigation losses, fair value amounts, things like that. So we want evidence that they are reasonable and we had adequate disclosure of them. These terms are easy. They're just kind of overly fancy words for very easy concept. Auditor's point estimate, management's point estimate. That's just that's their estimate. I don't know why they have to be all fancy and call it the point estimate. So a point estimate is the amount that they landed on, basically. So we got the auditor's point estimate, or they basically have a range of, reasonable estimates. The management will have their point estimate, and those are the things we're looking at to see if they're reasonable. Estimation uncertainty. I guess if any of these terms is, I don't know, I don't want to say important, but I can't think of a better way to say it. It would be this, how likely is this estimate? Really tough to know what it'll be, right? The susceptibility of an accounting estimate to an inherent lack of precision in its measurement. These are really fancy definitions, right? So that's just a fancy way of saying how likely is this number really tough to get at. Estimation uncertainty. We know what estimation uncertainty would mean, right? So, and then the last thing they define is the outcome of the accounting estimate, and that's the actual amount that results once it's resolved, because like we just said, was an estimate really? It's some approximation of something that we'll eventually know, right? We just don't know it yet, but we will. So as auditors, we're interested in how management goes about making the estimate, how management has assessed, the effect of this uncertainty. We should develop our own estimate, or at least a range, to evaluate what management came up with. And we definitely want to consider if the estimates might have some biases in them. Management are obviously probably going to tend to be more biased towards what will make them look better. So we definitely want to consider that, right? If there's just a significant amount of uncertainty, we might want to add an emphasis of matter paragraph to the report. We hadn't talked about audit reports yet, so we'll revisit that idea when we start talking about all the reasons we might have an emphasis of matter paragraph. So that'll come again later. But yeah, that's pretty much it. The strongest audit evidence for an estimate is just looking at the subsequent events and seeing if what they estimated really came true. Of course, you can only do that for things that occur before the audit report date. So that's usually not, you're going to be very limited on that kind of thing. But, you can get good information from estimates last year and how they kind of fell out. And if they're, the way they estimated this year was in line with last year, there's ways to assess this type of thing and be reasonably okay with it, right? But that's pretty much it. A few questions worth looking at. Number one, which of the following procedures would an auditor ordinarily perform first in evaluating management's accounting estimates? So again, pay attention to every word. First. So do we want to first develop independent expectations of their estimates? Or do we first want to consider the appropriateness of key factors or assumptions used in preparing the estimates? Or do we first want to test the calculations used by them? Or do we first want to obtain an understanding of how they develop their estimates? So first, all these are good things, right? But first, we're going to need to do this, right? I mean, it's kind of like list these in the appropriate order. We're not going to do any of these things until we have a general understanding about how they develop their estimates. I guess next in line would probably be considering the appropriateness of the key factors or assumptions used in preparing the estimates, but we can't do that until we first have an understanding of how they developed them to find out what those key factors were or those assumptions were, right? So this is first. You can't develop your own estimate, obviously, without understanding management's assumptions and factors and procedures. So keyword here is first. Number 3. In evaluating an entity's accounting estimates, one of an auditor's objectives is to determine whether the estimates are, all right, so again, pay attention to the words and what they mean. So objective is very broad. So A says our objective is to determine whether they're not subject to bias. That's an answer I'd hang on to as a possibility, unless I found something that we needed to do that was much more broad than that. But I'm not really bummed out with A as an answer to this one. B says consistent with industry guidelines. Okay, that's not an objective, right? C says based on objective assumptions, and D says reasonable in the circumstances. So I would have to land on D as the best answer. That is our more broad objective, is it reasonable in the circumstance, right? This is the best answer, but I could consider A as a good choice too. But the objective is it reasonable? It's an estimate, right? So we want to make sure it is reasonable in the circumstance. The not subject to bias thing is something we just need to consider as we are overall determining this, right? So lots of good questions tonight where you really have to drill into the words and the meanings and pay close attention, right? So this is good practice tonight for these. Number 4, in evaluating the reasonableness of an accounting estimate, an auditor most likely would concentrate on key factors and assumptions that are A, consistent with prior periods, B, similar to industry guidelines, C, objective and not susceptible to bias, D, deviations from historical patterns. All right, this one really bummed me out because I think that I don't like the wording. And it sent me in a completely different direction. If they had said something like, need to investigate instead of concentrate on, I would have been okay with this. But, you know, concentrate on means, what does that mean? I would concentrate on things that are objective and not susceptible to bias. I'd be like, concentrate. Okay, that's good. It's objective. You know, it's not susceptible to bias. I concentrated on that and figured that out to be a good thing, right? So if they had worded this differently, I would have gotten this one right. So if they had said, in evaluating the reasonableness of an accounting estimate, an auditor most likely would need to investigate factors and assumptions that are deviations from historical patterns, I could have answered this a lot easier.
Are there a lot of questions like this in the CPA exam?
No.
This one I would have gotten just because B is different from the other.
Well, that's the next point I was going to make. You got 3 good and 1 bad thing here. Yeah. So, so the answer to your question, as I was first interpreting it, is this would be a horrible question for a CPA exam because it's so horribly worded. Now, what were you actually getting at with the
Do they
question?
give answer choices like that a lot where it's pretty obvious, like these 3 are the pick one is different?
Yes. Yes. Picking the one that's different is a good test taking strategy. Yeah. Yeah. I kind of mentioned that a lot of times, like you got 3 bad things and 1 good thing. You got 3 good things and 1 bad thing. Which one doesn't belong? Yeah, that's always a good strategy. Yeah. So yeah, with this one, that would be a good strategy. It's like consistent with prior periods, good. Similar in industry guidelines, good. Objective, not susceptible to bias, good. Deviations from historical patterns, not good, right? But I feel like the vagueness of this question was really difficult for me. Because what does concentrate on mean? It means thinking about it. I want to think about the good things and the bad things about it, right? So this one threw me. But number 5, similar to what you were just saying, 3 goods and 1 bad, or 3 bads and 1 good, right? In evaluating the reasonableness of an entity's accounting estimates, an auditor normally would be concerned. All right, I like that better. Concerned makes me think, oh, I'm concerned I don't like this, right? So I'm thinking we're going to have 3 good things and a bad thing to find here. So I'd be concerned about assumptions that are susceptible to bias. Yeah, I'll be concerned about one that's susceptible to bias. Will I be concerned about one that's consistent? No. Will I be concerned about one that's not sensitive to variations? No. Would I be concerned about one that's similar to industry guidelines? No. So 5's a better question. And it's pretty much the same question as 4, just worded better. 6 takes a little bit of thinking, and we're not quite ready for it because we haven't learned about lawyer letters at this point, but that's the way it goes. 6 says, which of the following procedures most likely would assist an auditor in determining whether management has identified all accounting estimates that could be material to the financial statements? So we're 100% not ready to answer this at this point until we talk about lawyer letters and what they do, but that's where they stuck it, so we'll talk about it. So which of these will help us find whether management has identified all accounting estimates that could be material? All right. So A says inquire about the existence of related party transactions. And that's got nothing to do with accounting estimates. So I'm throwing that one out. B says we're going to determine whether accounting estimates deviate from historical patterns. I mean, that could kind of get at it a little bit. You know, really here, what we're trying to really land on is were all accounting estimates being recorded. The problem with B is we're kind of analyzing estimates that had been recorded. You know, if they've never been recorded, this wouldn't really cut it. And it's kind of a analytical procedure anyway type thing. So B's not that great. C says we're going to confirm inventories at locations outside the entity. Okay, again, not really dealing with accounting estimates here. But D says review the lawyer letter for information about litigation. So we're looking for all estimates being recorded. The lawyer letter, which we'll learn in a minute, is going to identify potentially any unrecorded estimates about potential litigations, right? So this is the best answer. This one takes a lot of really deep thinking to kind of get at. B would be the most tempting one to answer outside of D. But that would be a really weak way to try to identify whether all the accounting estimates that could be material to financial statements have been recorded. You know, say you recorded all the immaterial ones last year and you recorded all the immaterial ones this year, but you left off this really material estimate of some litigation or something. This little deviation of historical patterns is not going to catch that because we didn't record that last year either. The lawyer letter could help us. All right. Fair value estimates, not a whole lot new to add to this. Everything from the discussion on accounting estimates kind of applies here. They're really addressing the same audit standards. So I didn't add much more. High estimation uncertainty results for fair value estimates for derivatives that are not publicly traded or things can't be observed. That's a really obvious statement being made there. So published price quotations would be the best audit evidence of fair value. Yeah, whatever. Nothing much to add here, and no questions really to look at. So we kind of introduced lawyer letters with that last problem. Let's talk about those now. We want evidence about completeness regarding litigation, claims and assessments and things like that. Why are we so worried about completeness? Because we're talking estimates of big liabilities. Existence isn't going to be that big of a concern. If they've recorded this big old liability on there, then it's likely that it exists. Otherwise, they wouldn't record it. They don't want to record it, right? So we're more concerned with, did they record the things they should have? We're concerned about completeness. That idea can show up in questions too, right? You know, what's your risk area on certain types of accounts? You know, regarding this type of liability, existence is not that risky of an assertion to be testing. The completeness sure is, because they really don't have much of an incentive to record something that's not true. They do have an incentive to forget about recording one that does exist, right? All right, so management is the primary source of information about these things. Management's the primary source of information about all the things in the financial statements, pretty much, right? But we have to test it. So we should make appropriate inquiry. We should, this is always a good thing to take note of, read the minutes of the meetings. You can find things in minutes of the board meetings, you know, qualitative type things that it's like, oh, that might be a problem, or that, hey, they approved this, but I don't see where it actually happened in the, you know, that kind of thing. So minutes of the meetings to read, that's an important audit procedure. Reading minutes could help you identify potential claims and litigations and things too, from things they discuss in those meetings. But this whole chapter is really about sending this letter of inquiry to the lawyers. So we would send these letters to the lawyers that management would have to indicate that have provided significant legal services. You know, they say we should go so far as to identify or corroborate the identity of the lawyers by looking at charges to the legal expense account. You know, why not? That won't take that long to see what lawyers they paid, right? And then it says to examine /vouch to. And that kind of brings us to an important point that I always have to sit and think about for a second. So y'all know the difference between tracing and vouching, because these are terms that get thrown about quite a bit. Tracing versus vouching. All right, make a note. Tracing. So when you see an audit procedure that something is being, there's tracing going on as an audit procedure, that is tracing the document's path to the financial statements. So you have a document and you're tracing it to the financial statements. Vouching is the opposite. Vouching is taking numbers on the financial statement and finding the document or whatever. So I always have to think about it because it just doesn't automatically. Honestly, I don't think I've ever heard anybody in real life talk about vouching. They probably do, but nobody I ever worked with or worked for say, hey, you need to vouch that to that. We just, honestly, we just pretty much use trace as our terminology for anything, correctly or incorrectly. We knew what we meant, but no, truly, if you're tracing, that is, you have a document, go hunt it down on the financial statements. Vouching is, you got a financial statement number, go hunt it down in the document file or wherever you're hunting it down. That's tracing versus vouching. So here you're taking the legal expense account and vouching to the underlying invoices from the lawyers. Anyway, that's kind of going off to the side on the lawyer letters a bit, but it's an important point. So the purpose of this letter is for the lawyers to corroborate what management has actually already responded to you about legal things. If there are no legal issues, we would document that like we document everything. We'll cover a lot of the bases on this area in our management rep letter, which we'll talk about in a minute. But that's one of the things we would do if there were no legal issues. We'll get at that in the management rep letter too. Okay, so right here, for asserted claims. So an asserted claim is someone has actually filed a claim or at least announced that they intend to do so. So the lawyer should inform the auditor directly about any omissions in the lawyer letter for any asserted claims. But if they are unasserted claims, so there's exposure, it's like, oh man, this could go bad, but no one's really given any indication that they intend to sue, the lawyer is not allowed to inform the auditor about any omission of any unasserted claims. The bar forbids them from doing that. So that's an important point. So the lawyer can speak about only about asserted claims, but they cannot speak about any unasserted claims. So what they would need to do is tell the client about those and request that the management inform the auditors. So the lawyer can't directly speak about any unasserted claims. So they say, hey, we can't talk about this, but you need to let the auditor know about this. But this is also something we'll cover our bases on in the management rep letter too. We cover a lot of bases in the rep letter. So this is another one. And, this, y'all know our accounting rules for contingent liabilities. If it's probable, we record it. If it's reasonably possible, we make a notation, and we add it to the notes. And we disclose it in the notes. Yeah. If it's remote, don't worry about it. So, yeah, this would be something we would want to include as a note disclosure. Okay. Couple more points. This is a lawyer letter is a big deal. So if we can't get it, it's a scope limitation. severe enough that we couldn't give an unmodified opinion. So if the lawyer wouldn't respond, we would likely have to disclaim the opinion. If the client refused to permit the lawyer letter, that's the client not cooperating. We'd probably just withdraw from the engagement on that, right? It goes back to a lot of the things we talked about in those earlier weeks. So if the lawyer is just kind of being contrary, we would probably have a disclaimer. If the client wouldn't let it happen, we'd probably just say we're out. But the client wouldn't want us to have a disclaimer. So the client would be like, look, lawyer, you're going to have to respond to this. We need this audit opinion. So it would work itself out. Letter should be timed so that's dated close to the date of the audit report as practical. So we want to do that as near the end, just to have that additional coverage of time. That's about it. The lawyer will have the letter. The lawyer will include a professional opinion on what the expected outcome is. And that would probably be more about the reasoning on why they can't speak about the unasserted claims, because they typically would give their opinion on the expected outcome, and given an opinion on unasserted claims might be a little too much for them to be allowed to do. And they also have to limit their replies to litigations and claims that they have given substantial attention to. So that's kind of a guideline for them too. If it's an unasserted claim, they likely haven't given substantial attention to it. So there's a lot of reasons, I guess, they can't speak about those. But as far as why the bar specifically forbids it, I really don't know. But I understand the reasoning. So that's lawyer letters. Let's see, okay, these questions are kind of good because they're different, and it's good to get an idea of what to look out for on them. Number two says the auditor's responsibility to communicate with those. It's like, this is not the question. Okay, I'm wrong one. There we go. Sorry about that. Number two, which of the following statements in an attorney's legal letter requires further investigation? So another way to say this is, which of these do we not like? Which do we have a problem with that we're going to have to get some clarification on? So A says, the lawyer letter might say, we believe that the plaintiff's case against the company is without merit. That's pretty straightforward opinion by the lawyer that we're okay with, right? B says, we are of the opinion that this action will not result in any liability to the company. Yeah, that's a pretty strong statement, very clear, professional opinion. We're cool with that. C says, it is our opinion that the company will be able to assert meritorious defenses to this action. What the heck does that mean? All right, that's telling us nothing, right? What is a meritorious defense? All right, so this is too vague for us to like. We need more clarity than C. So C is the one that we would have to go back and say, can you tell us something a little more useful? D says, it is our opinion that the possible liability to the company in this proceeding is nominal in amount. That's pretty clear, right? It's not a material amount. So statement by the lawyer in C is too vague to be of use to us. So 5 was kind of similar. Which of the following statements would cause us to request clarification? A says, we believe that the possible liability is nominal. We're good with that. B says, we believe that the action can be settled for less than the damages claimed. I don't know what that statement even means. Do y'all? The action can be settled for less than the damages claimed. How much less? So we would go back and say, what you talking about here? C says, we believe that the plaintiff's case against the company is without merit. D says, we believe that the company will be able to defend this action successfully. So pretty clear on A, C, and D. B is left to a lot of interpretation, and it's very vague. So different types of questions for lawyer letters to be aware of with those two. Things that might be a little hard to answer first time, but after seeing a couple of examples, no problem, right? Number 6 is a classic. In auditing contingent liabilities, which of the following procedures would an auditor be most likely to perform? We would like to read the minutes of the directors' meetings to find those types of things. None of those others would help us, but that would. Yeah, that's a classic. Read in the minutes. That's a good answer for things like that. Number 8, which of the following is not an audit procedure that the independent auditor would perform concerning litigation? All right. A says, obtain assurance from management that it has disclosed all unasserted claims that the lawyer has advised are probable of assertion and must be disclosed. All right. We would want to do that. We'd handle that in the rep letter. B says, confirm directly with the client's lawyer that all claims have been recorded in the financial statement. That we would not do. C says, inquire about and discuss with management the policies and procedures adopted for identifying, evaluating, and accounting for litigation. Definitely would do that. And D says, obtain from management a description and evaluation of litigation existing at balance sheet date. We would do that. So B is the one that we wouldn't do exactly entirely that, right? We would do a bit of that with the lawyer. 10 is important. The refusal of a client's attorney to provide information requested in an inquiry letter generally is considered a limitation on the scope of the audit. It's easy, but it's important. It's not a reason to withdraw from the engagement. That's the attorney refusing. We can't say we're out because of what the lawyer does. Now, if that said, the client will not allow the attorney to do this, then we're done, right? All right, and it's not, and we haven't talked about adverse opinions yet, but this wouldn't be grounds for an adverse opinion. An adverse opinion means that we're saying these financial statements are not fairly stated in accordance with GAAP. Not having this letter would just be a limitation to our audit procedures. It wouldn't be evidence of a misstatement, right? More about that in a later section. Questions on lawyer letters? Pretty easy. Kind of different. Rep letter. This is kind of an easy section to read about. So we need to get a rep letter from management. They are going to have written representations about important, it's just they're answering important inquiries of ours written in the rep letter. So they'll have this directly addressed to us. It'll be signed by CEO and CFO and whoever else has overall responsibility. It could be signed by multiple people other than those people. If they were unwilling to sign a rep letter, that would be a scope limitation in which we would either disclaim the opinion or most likely withdraw, honestly, because that's a huge problem. That's right. We are not going to sign this to corroborate some of the things we've said. We're like, well, we don't trust you and we're gone, right? Take important note of this. The date of the letter is the same as the date on the audit report. So it covers the period up to that date. So that's a good little fact to tuck away. And then the rest of this is just, here's some of the stuff that would be on there, but I can't really imagine needing to memorize the types of things. It's just kind of a general familiarity with what a rep letter has on it. So it's going to have a big mishmash of things. They're going to sign off on a lot of things. Our responsibility is this. Our estimates are reasonable. We have properly disclosed related party transactions. We have properly accounted for subsequent events. We have any uncorrected misstatements at this point are immaterial. We have properly disclosed the effects of litigation and claims. We have recorded all the transactions. There's no fraud involving management. There's no undisclosed this, that, or the other. That's the type of thing you'll have in a rep letter. So pretty easy to kind of look at and study about. And a lot of these questions were just kind of throwaway questions that were super easy. Honestly, it's just 6 was worth looking at. Doesn't really belong in this chapter, but we had a similar type question on exam 1 that some of you may have gotten. And I noticed a few, maybe, well, I would say, a few got it wrong. I forgot exactly the wording on it, but it was along these lines. To which of the following matters would an auditor not apply materiality limits? Here it's saying when obtaining specific representations from management. On our exam, it was basically something like, which of these seemingly immaterial things would we consider to be kind of material? And it was a fraud thing. Any fraud would be something that would warrant our attention, even if the money involved was immaterial. That's certainly something we will have to deal with. So that's kind of the idea with number 6. They just relate it to the rep letter. So fraud involving employees with significant roles in internal control. If there's any fraud involving these people, materiality is kind of out of our mind. We're going to pursue this and figure out how deep it goes and if it goes any deeper. So any fraud's a big deal. Don't really think too much about materiality when it comes to fraud. Any fraud is material in our minds. Number 8, just to kind of put an example out there of, we can't memorize everything that's on a rep letter, but we can reason through it in that, this seems like something that would be on there. And these other 3 are not the types of things that would ever be signed off on anyway. So 8 says, which of the following statements would most likely be included among the written client representations obtained by the auditor? A says compensating balances and other arrangements involving restrictions on cash balances have been disclosed. I don't see any reason, I may not have specifically studied that, but I don't see any reason why that wouldn't be something on the rep letter. And that is in fact a standard thing that's on a rep letter, whether we read about it or not. We're going to get them to talk about making sure that they've disclosed, hey, we got cash, but a lot of it's restricted. Did you disclose this? That's the kind of thing we want to kind of drill down on at the end in the rep letter and make sure that they considered that and sign off on it and everything. But B says management acknowledges and signs off on their responsibility for illegal actions committed by employees. They're responsible for those. They have some responsibility involving, regarding that type of thing, but they're not responsible for those specific illegal actions. We've seen that as a wrong answer on a bunch of different questions this semester. C says they're going to sign off on the fact that sufficient evidential matter has been made available to permit the issuance of an unqualified opinion. Should a manager sign off on that? Is it their place to sign off on that? No, that's an auditor issue. D says they're going to sign off that they acknowledge there are no material weaknesses in internal control. There very well could be material weaknesses in internal control. They don't have to acknowledge that there are none. So A is the clear answer, whether we specifically studied that as a line item or not. 10 is simple after just reading the material, but I wanted to highlight it as, yes, it's simple after just reading it 5 minutes before answering the question, but will you remember it later when it's mixed up among all the other material you've had to learn? So be careful with stuff like that, right? Sometimes something like that's fresh on your mind, like how long you retain the audit documentation. That was easy to remember when we just read it, but will you remember it in a week? Maybe, maybe not. The date on the management rep letter, we just read that it should coincide with the date on the audit report. Will we remember that? Now, we would obviously not answer B or D on this, but we could be tempted to answer the balance sheet date if we didn't think about it. So, yeah, just be careful on really simple things like this that you just read about 5 minutes ago and it's fresh on your mind. Make sure to make a note of those types of things. It's like, maybe I need to make sure I will remember this in a week or two. Of course, hopefully you're looking at this continuously throughout each week. That's the best way to do this, instead of looking at it and not looking at it again until test time. One more, number 12. It's more about the audit dates, but they throw in a little hiccup into this one that you have to kind of consider. So Key Company plans to present comparative financial statements for the years ended December 31st of 05 and 06. Tell how old this question is. Smith is the CPA doing the audit of both of those years, and they're going to report comparatives, and the report date is May 1st of 07. Very straightforward so far, but Key's current management team was not present until January 1st of 06. What period of time should be covered by the management rep letter? So you kind of stumble and you're like, well, does the rep letter need to cover just after January of 06, or does it need to cover the period of time that covers all the financial statements being presented? And the answer is, who cares what management was in place, right? The rep letter needs to cover the period of time of the reports that are presented all the way up through the audit report date. So it should be the beginning of the first year presented, which is 05. So it should cover from January 1st of 05 all the way through the date of the audit report, which is May 1st of 07. That's what the rep letter covers. So a little bit of new information to learn in that. All right. Questions on rep letters? Super, super easy. Related parties. When you think related parties, you think disclosure is the key. Related parties are not a problem. Not disclosing them is a problem. That just streamlines that right down to that one word. So related parties are fine. Disclosure is key. That's our big concern as an auditor. Now, as an auditor, obviously we want a little more understanding than that. We want an understanding of that relationship. We want to be able to address risk factors such as fraud and that kind of thing. But really, we are just concerned with the adequacy of the disclosure about transactions with the related parties, because the related party transactions are different. You know, you're dealing with related parties. They could potentially set the transaction price at whatever value they want without any regard to real economic value, because you're dealing with your buddies and your family and that type of thing. So it's fine. It's real transactions, but it's different. And if you don't disclose that, you're leaving out key information. Yes, our interest expense is super low because we have this loan with these guys who are our best allies, and they gave us a very unreasonably low interest rate, and that's that, you know, that kind of thing. I don't know if that's a good example or not. That's just what came to my head. But yeah, that's it. So we want full disclosure here. We want to make sure they are fairly presented. So that's that. Questions to look at on that? I highlighted just a couple. Number 2. In auditing related party transactions, an auditor ordinarily places primary emphasis on A, the probability they will recur. No. B, confirming that they exist. No, not primary emphasis. Verifying the valuation. Not really. Adequacy of the disclosure. That is key, right? So there you go. That is primary emphasis. That doesn't mean we don't care about the other things, but that is our primary emphasis. 4, after identifying related party transactions, an auditor most likely would A, substantiate that the transactions were consummated on terms equivalent to those prevailing in arm's length transactions. That is not something we care about. Okay, it's a related party transaction. It's probably not going to be. B, discuss the implications of the transactions with third parties, such as attorneys and bankers. Nope, don't care. Not a big deal to us about that kind of thing. C, determine whether the transactions were approved by the board of directors or other appropriate officials. That would be a concern. I don't know if it's our primary concern, but it is a concern, and they're not asking about our primary concern. So C is probably going to be it. A's not, B's not. Let's see about D. D says ascertain whether the transactions would have occurred if the parties had not been related. No, we don't care about that. We are not worried about anything other than, you know, our big concern is disclosure, right? We're not as really concerned with the transaction itself and how it came about and that kind of thing. Approval of that transaction might be a concern, right? But the substance of the transaction, you know, we're not really worried about the legal form of it. We just really want to make sure it's fairly presented. We don't care about all these other things. We don't care about arm's length, prevailing rates and things like that, and what would have happened if it hadn't been a related party. That doesn't matter to us as long as it's disclosed. Those were the 2 I kind of highlighted to look at. The others were either throwaway questions or kind of obvious questions. Any questions for me? PCAOB guidance on related parties. I just kind of combine these into one section. There's nothing new to add. So I just kind of left those as the same section essentially. Related party was the last thing we talked about. So, all right, I don't know why this little thing pops up every now and then, but there's no getting rid of it. It just stays. But that's going to get really annoying. I wonder if it's because this is open. It is. Okay, good. Now we're good. Okay. So that puts us ready for, and this is a pretty meaty little section here. There's a lot of content to it. It's not that difficult, but there's a lot to kind of remember. You know, nothing in audit's super difficult. I mean, if anything's difficult, I feel like it's those transaction areas from a couple of weeks ago with the internal controls and the purchase orders and, you know, following things through the process. That to me is the most difficult thing we do. Most of audit's not that difficult. So just spend a little time learning it and you should be good. So with subsequent events, so we're talking about different scenarios here where we're done with the audit and we haven't released the report yet. Things might be happening. What do we do to deal with certain situations after the balance sheet date, before the audit report's issued, or after the audit report's issued? It covers that as well. So, you know, our objective as auditors is to make sure the subsequent events are properly reflected in the financial statements. That's a really broad statement, right? What does that mean? So as with everything, management is responsible for all the things, right? We are responsible for testing those things, right? So management's responsible for evaluating any subsequent events up to the date the reports, you know, the financial statements are going to be issued, made public, right, before the audit report's going to be out there. So they're responsible for evaluating any subsequent events up until that date of issue. There's even a section in the management rep letter that we talked about last week about whether any events occurred during the subsequent period that requires them to go back and adjust the financial statements, or that requires them to go back and disclose something, or both, right? So management is supposed to consider any subsequent events that could affect the financial statements between balance sheet date and audit report or financial statements being issued, right? So what is a subsequent event? Like we just said, it occurs between the date on the financial statements and the date of the auditor's report. All right. There's also subsequently discovered facts that are being defined here, and that's a fact that becomes known to us, the auditor, after the date on the auditor's report. If we had known it before, we would have had some revisions, right? So what are we talking about? Well, there could be, back to subsequent events, there could be a subsequent event that gives new information or maybe just better information about things that are on the balance sheet or whatever, you know, in the financial statements. You know, we may have had a contingent liability as of the balance sheet date that resolved itself. Now we have better information we don't have to estimate that number anymore, right? So we know the amount, we can go back and adjust that amount to what reality was. It's no longer contingent. There's no longer estimations to be made, right? So that's good, right? It's good, new, better information. We'll go back and fix it because we know, and that could be for anything we're estimating, you know, receivables that may have become uncollectible or, you know, that kind of thing. So that's one thing, and that's easy. It's like, hey, this is in the financial statements. Hey, new information about that thing that's in the financial statements. Let's fix it, right? Okay, another possibility could be some big event that happened that's not related to something in the financial statements themselves. So we don't have to go back and adjust them because it's a new thing that happened after the balance sheet date, like a tornado or an earthquake that wipes out the facilities. All right, financial statements are still good. You know, they're dated December 31st. They're accurate, right? We don't go back and make adjustments because everything is true as of December 31st. So it wouldn't be proper to go back and adjust those. What we would do, though, is we don't want to be misleading. We want the information to be there. So we would have a note disclosure that said, hey, February, there's a big old tornado that wiped out the facility. So we got that going on. Just to let y'all know, you know, it was after the balance sheet date, so we didn't make any adjustments to the financial statements, but here's the information about that, and it's a big deal, right? So we would disclose something like that. So you get a lot of test questions where you have to pay attention to the dates and, you know, did this happen after the balance sheet date? If so, you know, we don't have to adjust the balance sheet, or did it happen and just give us new information about something from before the balance sheet date, then we would adjust it, right? So it all depends on when it all happened, right? So that's pretty easy. It's pretty straightforward, right? Customer has an outstanding accounts receivable balance that's recorded on the balance sheet, and come about January or something, that customer declares bankruptcy, and you're like, well, we're not going to collect that. We go back and adjust it. We have new information about something that's in the financial statements, right? Okay. So there you go. So what about audit procedures regarding any subsequent events? We ask management, and we've got the rep letter where there's a specific reference to that they'll have to check off. We look at board minutes, meetings of minutes, including not just minutes of the year under audit, but subsequent meetings as well. You might find good information in those too. So we would review meetings up to the date of the auditor's report, because you have some responsibility for things up until that date. The lawyer letter could be relevant. We talked about that last year. That'll shed some light on legal contingencies. We look at journals and ledgers after year end to see if anything big hit, anything unusual, that kind of thing. That's some of the procedures we would do. So what if there are some things that are subsequently discovered before the audit report is released? So things are discovered. If management revises their financial statements, it's proper for us as the auditor to, of course, perform some audit procedures on that revision, right? And that could vary depending on what it is. And these are kind of obvious statements, both of these. If management does not revise financial statements and we think the revision is necessary, then we would modify the audit opinion. They're not they're not in accordance with GAAP at that point. Hey, you should have done this, you didn't. We don't agree that financial statements are in accordance with GAAP, so our opinion will reflect that. So two obvious little statements right here. What's a little less obvious is, what if there's some kind of material thing that's discovered after the report is released and it is related to the balance sheet date, right? If it's not related, to the balance sheet date, we're kind of done, right? But what if we do our audit, we release the report, then it's like, oh, wow, look at this. That's related to the balance sheet date and it's a big deal and we haven't dealt with that. Okay. What are the possibilities? Well, management could revise the financial statements. We would have to assess whether the action they're taking are timely enough to inform users. We'd have to assess whether our opinion needs to be changed. And that could be maybe just the addition of some emphasis of matter paragraph. So we would perform appropriate audit procedures on the revision they make. But then management might not revise the financial statements. So then we're back to deciding if we agree with that. If we believe they should have revised it, then we've got responsibility to see what kind of damage is out there, right? It's like, they didn't revise, we think they should have. Let's see what's going on. So we were going to figure out if the financial statements have been made available to third parties. If they haven't, then we say you don't need to put these out there until you fix this or until we issue a new report or whatever. If they have been, then we have to figure out if management has taken some kind of appropriate step to make sure to inform users not to rely on them. So, kind of obvious stuff, really. It's just a lot of what ifs here. There's no big mysterious, that's odd that they do that. It all makes sense, right? What the appropriate steps are. So it doesn't make it that difficult. There's so much content here. And I put red on this because I'm like, this is a little bit overkill for us having to learn all this stuff. So I highlighted that little section in red. And just to say, let's not worry about that. But let's do worry for sure, because I feel like this is where the majority of your test questions might come from, is the date on the audit report. And there's a lot of what ifs here as well, but it's fairly straightforward if you just kind of have to remember. So the rule is the date of the audit report should never be earlier than the date on which the auditor has obtained sufficient appropriate audit evidence to support the opinion. And back in the day, it was like the last day of field work. Okay, they, and rightfully so, have made that a different date now. It is the date upon which sufficient appropriate audit evidence has been fully obtained. That's your audit report date. All right. So now we've got subsequent events happening. What does that do to our date? So if we've got subsequent events after so-called field work, but we haven't issued the report yet, there are some what ifs here as far as dating the report. If we're just going in and adjusting a number and there's no financial statement disclosure in the notes specifically related to that, then the date is just whatever date you deem yourself to have obtained sufficient appropriate audit evidence, completion of field work or possibly later. The point there is there's no need to dual date this new thing. All right, we're getting into heavy little nitpicky areas here where it's like, here's the date of the audit report and you're dual dating this new thing, just to say, hey, here's a new thing here. We're dating later, saying to you guys that we're responsible for this as of this date and everything else as of this earlier date. You know, if you just dated the whole report later because of that one subsequent event, you're putting yourself out there to be responsible for everything as of that new date. And that's kind of putting yourself too far out there, right? So if it's a subsequent event that occurs prior to issuing the audit report, if you're just adjusting a number and not adding a new disclosure, just stick a new date on there to cover, you know, everything. If the adjustment does have an accompanying disclosure, or if there's just a disclosure and no adjustment, bottom line is if there's a new disclosure hitting the books or the financial statements rather, then you can either dual date where you have one date for the overall report and a later date just for that new subsequent event, or you can date the entire audit report as of that later date, but that makes you, like I said, responsible for every subsequent event up to that date. So that is the deal. So if you're just adjusting a number, stick with whatever date you finish field work or whatever date you obtain sufficient appropriate audit evidence. If you have a new disclosure, then either date it at that later date or leave your original date and dual date for that subsequent event. Lots of things to kind of juggle here, but pretty straightforward, right? All right. Yeah, the rest of that, that's the main thing right here, really. All right. But they give some other little what if scenarios here. You know, that we just talked about with subsequent events after field work, but we hadn't issued the report yet. What about subsequent facts after we've already dated the report? Well, we can dual date or we can revise the date and extend audit procedures to cover the new revised date. We have to obtain an updated management rep letter as of the new date. A lot of work involved there, right? So that's kind of the allure of dual dating, is just like stick with your original date and dual date this new thing, right? All right. Let's see, is that the end of the notes? Yeah, so what else should we add here? That's probably fine. You know, the auditors, we don't have an active responsibility to make any inquiries or perform any further audit procedures to discover subsequent events after the original date of the audit report. But if we become aware of anything we do need to consider whether we need to do some of these things. All right. They add a lot of questions on here, and I don't want to go through all of them because it's a lot, but how about some of the highlights here? How about number 4? Which of the following events require, I'm kind of choosing these because these are kind of typical, kind of classics right here. Which of the following events requires adjustment to the financial statements for the year ended December 31st, year 1? All right, so we would only adjust if the information relates to things as of that year end, right? So looking at the answer choices, it says in A, we would adjust because there was a loss on accounts receivable as a result of a customer suffering a major loss from a flood in January of year 2. So that wouldn't be, because the event that caused this problem happened after our year end, right? That thing that happened doesn't relate to December 31st, year 1. So that one doesn't work. B says it's a loss on an account receivable as a result of a customer suffering a deteriorating financial condition that led to bankruptcy filing January year 2. It's a subtle difference between A and B. B's actually the correct answer, because this deteriorating financial condition was happening during the financial statement year that we're auditing, right? So with A, the event occurs after year end that caused this problem regarding the customer. With B, the event does belong in year 1. You know, they're having financial problems. We have better information about how bad those financial problems are that are going on during our financial statement year because of what happened in January, right? Very subtle difference in A and B, but it makes sense, right? C, we lose inventory because there was an earthquake in January. Okay, we wouldn't make adjustments to numbers, right? Because it happened after our financial statement date. We would disclose it in the notes. And then D says sale of a bond in year 2. That's just, that's just business happening in January. So does that make sense in number 4? I like questions like that. It makes you think a little bit, but they're easy to deal with, right? Number 5, on February 17th of year 2, the company had a fire that destroyed a plant. The building and equipment and they give you all these numbers. They anticipate insurance proceeds and all of this. So we're auditing December 31st, year 1, year end. We completed it February 25th after that fire happened. What should we do about reporting that fire in the year 1 financial statements? Well, it happened in year 2, so we're not screwing with the numbers at all, right? We shouldn't do that. But it's a big deal, so we would want to be above board and disclose it in the notes, right? So whichever one of those says leave the numbers alone, but make sure and let us know about it is the answer. That's the one. So financial statement should disclose in the notes, but no financial statement adjustment. So there you go. A, B, and D have us tweaking numbers. We're not needing to do that. Number 6. An auditor should be aware of subsequent events that provide evidence concerning conditions that did not exist at year end but arose after year end. These events may be important to the auditor because they may what? Require adjustments to the financial statements as of the year end? No, because we're talking about subsequent events that did not exist at year end. So we're not properly going to adjust anything. B says have been recorded based on preliminary accounting estimates. What that means. These events may be important because they may have been recorded based on preliminary accounting estimates. kind of a stupid one. I'm not real sure what they're getting at, but that's not the right answer. C says these events may be important to the auditor because they may require disclosure to keep the financial statements from being misleading. That's exactly what we do, right? That's our whole thing. And how about number 10? Because it's an old CPA question. Oh, no, it's not. They amended it because there were new standards since that question was first written. Okay, so 10 says, Wilson, CPA, completed field work of the audit of December 31st financial statements. Field work was completed on March 6th, year 2. That is the time where they thought they had obtained sufficient appropriate audit evidence to support the opinion that they have. Okay. However, a subsequent event requiring adjustment to year 1 financial statements occurred on April 10th, year 2. And it came to our attention on April 24th, year 2. That was before the audit report has been issued. It's a lot of content for kind of an easy question that's coming up. If the adjustment is made without disclosure of the event, what report should they date? What should they date the report? They're sticking with the date that they obtained sufficient appropriate audit evidence. They're going to stick with March 6th, year 2. That's what they're going to do. They don't have to, they don't have, it's subsequent. Yeah, the dates all, we don't have to go through all that again, but the key is it's an adjustment with no disclosure. So we don't have to dual date it. We don't have to modify the date we landed on before. We leave it as is. Now, if we had a note disclosure, that's getting a little heavier and we're making additions at that point. Here we're just tweaking the number because of new information. Start adding disclosures, you're really modifying that financial statement package to the extent where you will have to change your date. All right. Most of these questions were pretty good, but I think that's a good sample of the good ones there. Questions on any of them? Nobody had made any note comments about these that I remember, so we can move on if there's no questions on that section. It's a meaty section with a lot of potential test questions, so make good notes about it and practice as many questions as you can. Going concern, that's a pretty important area too, as well. A lot of potential test questions from this topic area. Pretty easy to deal with, easier than the other. There's not a dates to keep straight and what ifs to keep straight. So this is fairly straightforward once you get it straight. And in your mind, what our responsibilities are, right? As far as going concern goes, now keep in mind, our main purpose is figuring out that the financial statements are presented fairly, right? So our concern is this company a going concern? If not, their financial statements are wrong, right? Think about it. If they're not going to last for a year, there are no long-term liabilities. There are no fixed assets that are, there's no long-term items anymore. Everything's current, right? So the basis of accounting, the going concern basis of accounting is out the window at that point. So that kind of gets at what our responsibility as auditors are. If it's not a going concern, those financial statements are wrong, right? If they're using a going concern basis. So we need to obtain evidence whether management is appropriately using a going concern basis of accounting. That'll come to light as we're doing our normal audit procedures, right? And then we want to conclude whether there's substantial doubt about their ability to continue as a going concern. So that's our responsibility. Management has to evaluate the same thing and do their financial statements accordingly, right? So They have to determine if there's substantial doubt, and then they have to either decide to use a going concern basis that we're all familiar with. We don't usually call it that, but it's just normal accounting, or a liquidation basis of accounting where everything's going to be dealt with way differently. But yeah, as far as audit requirements, we're doing normal audit procedures. That's usually fine. You know, if there's going concern problems, they're going to come to light. We don't have to design specific going concern audit procedures unless we identify things that do raise substantial doubt. Then we might have to do additional audit procedures. And it'd be things like I think there was a practice question that got at this. I don't know if our notes specifically mentioned it. But I think one of the things that the question kind of hit on was we might go looking at debt agreements to see if there are any major modifications to debt agreements. That would be evidence of potential problems, right? That's the kind of test question you could get, and they're real easy to handle. It's like, you know, what of these things might indicate that there's possibly substantial doubt about this company's ability as a going concern. And it's easy things like financial problems, labor problems, negative trends, loss of a major customer, you know, that kind of thing. Those are super easy types of questions. But what the notes do specifically mention is we would request management to evaluate, because it's, you know, they're the ones to make that evaluation due if they've not already done so, about their ability to continue as a going concern. If we deem that it's very important that a third party provides financial support, you know, if that's a big part of the management's plans, we need to go further and talk with them and get, hopefully in writing, about their intent to do this and ability to do this. And we'll look at debt things to see if there's been any reorganizations of debt, and if that's, you know, that kind of thing. It's hard to ask good test questions on that kind of thing. What is easy to ask test questions on, though, is what do we do with the auditor's report? And here's a list of, if this happens, we do this. If this happens, we do this. If this happens, we do this. These are all easy test questions to answer, and easy ones for them to ask. So it's not something to memorize. It's just something to understand, because you can get questions in any audit area about this, and it's all kind of the same. You know, here, if they're using a going concern basis of accounting and they shouldn't, then they are not fairly presenting their financial statements. That's an adverse opinion. We hadn't talked did the different opinions in depth yet, but we know from undergrad audit the basics of this. If there are disclosures they should make, but they haven't done it, or they're not adequate, then it's an adverse opinion if it's pervasively a problem, or a qualified opinion if it's not as pervasive, right? All right. If we're unable to obtain sufficient appropriate audit evidence, as always, that's a scope limitation that requires us to either qualify the opinion if it's just a little, you know, not a pervasive thing, or disclaim an opinion if we can't render an opinion, right? So, you know, you could take this language and apply it to any audit area, and the result on the report is the same. If we're unable to obtain sufficient appropriate audit evidence in any area, it's either a qualified opinion or a disclaimer of an opinion. If disclosures from any area on the financial statements are inadequate, it's either a qualified opinion or an adverse opinion, right? The fourth thing there, if there's substantial doubt about going concern, but using the going concern accounting is appropriate, then we don't have to qualify an opinion. We don't have to give an adverse opinion. But we might have a going concern section in our audit report. We'll talk about all this in more detail in the audit report section of the text. So that's coming up, but it's good to mention it here too. We're not allowed, and this would be obvious, but we're not allowed to use what they call conditional language along the lines of, unless the company does X, then there's substantial doubt about its ability to continue as a going concern. We wouldn't do something like that. That'd be beyond our, I don't know what word I'm looking for. That'd be way beyond what we're allowed to do. All right. So we're looking for things like, that might indicate substantial doubt, like financial problems, labor problems, bad trends, loss of a customer. But we're also going to look for mitigating factors that make this okay. They've got a plan that's going to make this okay. They may be fine. Things like plans to restructure their debt, plans to borrow money, plans to sell off some assets, streamline things, plans to delay expenditures temporarily. So we could look for that as well as we're making this determination. All right. Okay, so that's going concern. Pretty straightforward. Let's grab a little sample of questions here. You'll find that they're fairly the same. Number 1 says an auditor has substantial doubt about an ability to continue as a going concern for their client because there's negative cash flows and working capital deficiencies. Under this circumstance, the auditor would be most concerned about what? So what are we as auditors most concerned about? Whether the financial statements are fairly presented in conformity with GAAP, right? So that's what it all comes down to for this. Are their financial statements doing what they're supposed to do? Number 2, which of the following audit procedures most likely would assist us in identifying things that might indicate there's substantial doubt about their ability to go as a concern? All right, so I think everybody would be find this easy to answer. Which of these would help us identify substantial doubt about their ability to continue as a going concern? Confirming receivables? No. Reconciling interest expense with debt? Absolutely not. Confirming bank balances? No. Reviewing whether they can comply with their terms of their debt agreements? Obviously, that would be a big signal on how well off they are, right? If they can't comply with the terms of the debt agreements, that's going to kind of give us an idea that they're in trouble, right? So we start looking at their debt payments and see if they're in accordance with what is expected. So pretty easy. I think those were the main 2 I wanted to look at. They had a couple of questions last year that I liked that they've removed for whatever reason. So kind of bummed out about that. But I think it's just kind of repetition from some of the others. There was a number 4 that I liked that's no longer there, but it again hit on the same idea that it all comes down to the effect on the financial statements. There was a number 5, but the same idea. It all comes down to whether the financial statements are fairly presented. So I guess they just threw those out because they didn't want that much repetition. However, later on, I think there's a question that is repeated word for word in one of the assessment sections. So it's like, it's just in there twice. I don't know. No. All right, questions on going concern. I had a copy of audit programs, standard audit programs that we used to use when I was doing auditing, and I grabbed the going concern checklist just to see what all's on there. So it's got a list of things to be on the lookout for that could indicate substantial doubt. So, audit programs guide you through all this. It's like, are there negative trends? And they give a list of things like recurring operating losses, working capital deficiencies, negative cash flows, adverse key financial ratios. All right. Are there other indications of possible difficulty, such as default on a loan, arrearages in dividends? They hadn't been paying dividends like they used to. Denial of using credit from your suppliers. They won't sell you on credit anymore. Restructuring of debt. Need to dispose of substantial assets. Are there work stoppages or other labor difficulties? Is there legal proceedings, loss of a license or patent or key franchise, principal customer, supplier, things like that? It's all listed on a little checklist here. So nice and handy in the real world. All right, so that takes care of everything from last week.